Good day, everyone. Welcome, welcome, welcome. We are so thrilled that you are all here with us. We're going to have another fun presentation. We've got this really great gentleman, Mark Panic. I want to call it Panic.
Pantak.
I like Panic better. Pantak. He's going to talk about so many of the deals that he has done over the lifetime of his learning how to invest starting in Dallas in the 1980s with fourplexes. And he continued with single families along with his multifamily. And he liked to call it playing Monopoly in real life. Mark began investing in Dallas. I already said that. And he did everything wrong and lost it in the downturn of the 1980s, but not the 2008, because by then he was way too smart. So he's going to talk about the things he did wrong, how to buy right, which now he knows how to do that. He's closed over 300 transaction, and the most recent one was a 100-unit syndication in Texas in September of 2024. He combines single family and multifamily to play the Monopoly game, as we said, and he was going to discuss what's going to happen in our economy in 2025 in many assets of life, like seniors, what's trending, and real estate. So, Mark, thank you very much for being here, and please take it away.
Thank you, Peggy. Appreciate the opportunity. So I'm just going to go and give like a 30,000-foot view initially. So for many people I talk to, the challenges in terms of getting into whether it's a single family house or multifamily is large down payments, especially with the lack of affordability we have now. I mean, in California, a basic starter home is like $1 million plus. So, people are having to put, if there's 20% down or more, 200, 250 or more. Same with apartments. And so I've had people over the years say, well, how do you invest in these? How do you get these? And so the old traditional way, I don't know how many people can relate, but when I was a kid, I played this thing called Monopoly. And in Monopoly, for simplicity, if I could say it correctly, you go around the board and you land on something and you buy a little greenhouse. And then you buy another little greenhouse, and eventually on that one particular property, you build up to you 4 little greenhouses, and then you can do from the 4 little green a 1031 tax deferred exchange, and those were red hotels, but might as well just be an apartment complex or any commercial property that would fit. So the big picture I say to people all the time, well, imagine this: you buy a $200,000 house for 50 cents on the dollar, or you're part of a group that might be involved with this, and now you are able to get a $50,000 equity on that property. You do that 4 times, and the 4 times on that 50,000 is now 200,000. Now you got 200,000 to play to put into some multifamily. So that's been one of the challenges I've come across talking to people all the time, because I say the number one thing I say to people is, are you in the game? That's the number one thing for 2025 that I tell people: stop standing on the sidelines and figure out how to get in the game. And so I ask people all the time, why aren't you, are you investing? Well, I'm starting. Okay. How long have you been starting? 5 years. So I say, have you bought anything? Well, there's this and that and everything else. Well, one thing I can tell you is for certain, taxes will always continue to find a way to go higher. And real estate, as we all know, is one of the best ways to offset that. So, and also we're all getting older. One of my favorite jokes is, what they say about bald men. Bald men who are balding in front are thinkers. Balding in back are sexy. Those balding all the way across, we just think we're sexy. That's one of my favorite ones. That's give me a good chuckle. So the point being in all this is that right now, 10,000 people a day are turning age 65. Wow. Right now, there's a shortage of affordable housing. There's additional approximately 8,000 that are turning 75. The population is aging. There's going to continue to be a trend toward improvements in healthcare and people living longer. A lot of people are going to outlive their retirement and the retirement savings, especially when we have the government printing trillions of dollars, giving it away, doing all kinds of things, going in debt. And so the combination of all these things, people are sometimes scared and freaked out by these problems. And here's the thing, if you're going to write down one thing, write down problems are opportunities. Problems are opportunities. So most people, they go, oh no, interest rates aren't 3% anymore. They're 8% or whatever they are. And they get scared. As Warren Buffett's been quoted, when people get greedy, get scared. And when people get scared, get greedy. Because now's the time to start getting greedy, because opportunities are going to be coming. Where people couldn't find deals before, foreclosures are trending up. I'm targeting areas where the foreclosure numbers are increasing. And again, I see this all the time on the internet. Well, it's not like it was in 2008. It doesn't need to be like it was in 2008. I only need one foreclosure a month if I'm doing a house. And then from that, I do 10 in a year. That could be $500,000 right there. And I can then use that to roll it over into some multifamily, into a mobile home park, into some commercial opportunities. So, I mean, I guess some people are born with a silver spoon in their mouth and they come out of the womb with $500,000. I wasn't quite so lucky. So I grew up in Michigan. My mom was a nurse. My dad was an engineer. And so but very first place I lived in was a mobile home. Now, I've got fond memories of being a little kid living in that mobile home park. We had a little lake behind. So there's right now a shortage of affordable housing. This shortage of affordable housing, this problem is an opportunity. It's especially for people on fixed incomes, limited incomes, people who are veterans, people who are disabled. So if you can find ways to solve the crisis, to solve the problem, there's a lot of homelessness going on, especially places like California, because it's got so expensive. About the only solution a lot of people have is to move. And I say to people all the time, well, what's the cheapest, especially I'm talking to people in California, what's the cheapest you think I bought a house for recently in Texas? They go, well, I think I saw something online for 120. Well, what if I was to tell you I bought houses for 2,000, 5,000, 10,000? They're like, what? Well, that's because I buy in smaller towns. And when I buy in smaller towns, one of the things I do is I go ahead and I find there's no shortage of people who are older that are having a trouble finding an affordable place to live. And so I also sell these houses. And so I might buy a house that's worth 120, but the person died. Why? In these small towns, in Texas even too. If you don't have a Dallas, Houston, Austin, San Antonio, the big four, you get out of those cities, that's where the jobs are. That's where the high paying incomes are, $100,000 plus. There's 254 counties just in Texas, as an example, since I know Texas well. Of those 254 counties, there's 10 I've identified that are not Dallas, Houston, Austin, or San Antonio. However, those counties are the county seat, and they've got infrastructure. Sometimes the population is only 25 to 50,000. However, within that, there are still sometimes housing shortages, even there. There's housing shortages all across the country. One of the markets we just bought in, Abilene, Texas, we got a 100 unit there. That 100 unit, they're all one story. They're not two story. And the most of the residents are seniors and veterans. And so basically we've got affordable housing, and they're not building new apartments in Abilene. So because of the demand, there's like 95% occupancy. And there's an article I looked up that it says there's a shortage in Abilene, but they're not building. So there's these problems that are opportunities. And when you buy, the rate of loans, not loans, rents, that's what I was trying to think of. So rents went up like 8% in Abilene because Abilene lags behind the Dallas, the Houston, the Austin, San Antonio. That's part of the reason why we bought there, is because we're looking for secondary, tertiary markets. It's like 125,000 population. There's a military base there. There's a couple colleges there. There's a good infrastructure. Abilene's not going to go away, but most people say Abilene, I don't even know where that is. Well, you get Dallas-Fort Worth, get on the interstate and head west, eventually you'll come to Abilene. So we picked up that property for like 6.6 million. They were asking 7 million. There's opportunities. It's a value add. So the rents are below market. We feel we can potentially raise the rents by $100 a door. Then on top of that, they've not been updated. So we're going to have a renovation budget between $200,000 and $500,000. And on that renovation, once we improve those units, we're going to do like we did on our property just outside of San Antonio. The rents were $850 a door. Well, in San Antonio, And again, it's about 30 minutes. We're in the county just outside of San Antonio, and it's right off the interstate. There's a super Walmart right there. But the 2 bedrooms at $850 in San Antonio, the equivalent is $1,200 to $1,500. So we have people who couldn't afford the San Antonio market, and also their families more in the rural area too. But there's a Toyota factory that they're working at there. There's the medical district they're working at there. So jobs are a key. One of the things I always look at is where are jobs going, where are jobs trending, and what's the proximity from a smaller community to get to a bigger where the jobs are. So it's a combination of these things, in my opinion. And one of the other big things that people haven't been thinking about, there's a lot of multifamily. Matter of fact, $500 billion in loans that are going to be coming due. And as these loans cycle, some of those loans were shorter term loans. The average loan used to be closer to 7 to 10 years. Lately, they're now 5 to 7 years. So as these loans on these properties cycle, there's going to be some people that are going to have some problems. Now, there's been some appreciation. There's been some equity available. So that'll be offsetting this. But there's going to be some opportunities. And so part of, some people say all the time, how do you find these multifamily deals? Look, there's ways to get data. There's Yardi. I'm sure many of you are familiar with Yardi, but there's different places that you can get data sources and find out which properties are going to be coming up. And naturally, a savvy operator, they're not going to wait till the last minute. They're going to, if they got a 5-year loan, say out 3 years, 2 years before it's due, they're going to get busy looking at refinancing that property or possibly selling that property. So getting early in the pipeline is very important. And basically, right now, there's another opportunity. It's called senior housing and assisted living. With all the people, there's 70 million baby boomers. And of these 70 million baby boomers, depending on the sources you go to, we're short over 1 million beds. So some people are focused on getting into that market, and it's called RAL, residential assisted living. So there's big operators, and there's also smaller entrepreneurial operators. But literally, there's people. I just was at a convention in Phoenix. It was fantastic for the RAL, residential assisted living. And so people are making incredible cash flow on these properties because they're taking, in some cases, a single family home that might be a 5-bedroom. They're putting 2 beds in each one, and they're having 10 beds available, and they're renting them out at $5,000 per month per bed. Well, if you add up $5,000 a month per bed times 10 beds, that's $50,000 a month after all expenses, depending on how you're operating. You could have between $10,000 to $20,000 a month cash flow after paying for the staff. Now, that is another problem. That's an opportunity because there's a shortage of finding good staff. So that's another problem. That's an opportunity. So some people eventually, they're probably going to get in the business of training, recruiting, and staffing. So that's the entrepreneur mindset of what's the problem, what's the opportunity, and how can I profit from it? So there's going to continue to be people that as they age, right now there's a whole opportunity. I become a certified senior transition specialist. And part of the reason I did that is because part of the thing that happens is quite often women outlive men to this day. And so say there's a husband and wife, they bought a house 30, 40 years ago. The kids are grown and gone. The husband passed away 10 years ago. And mom, I just use my own mom as an example, wasn't big on maintaining the property and also liked to collect things, was a hoarder. So when you combine hoarding with a deferred maintenance and it's gone on for 10 years, and then mom gets to where she can't take care of herself and she's falling down, and the doctor or the hospital saying, hey, you know, she's going to need more care, and even like the in-home care is not enough. What happens is people often don't have that money to pay for that care. And so what's the only asset that many Americans have and the mom has? It's the house. So some people are positioning themselves like myself, and what we're doing is we're building relationships with these communities and building relationships with the placement agents. So because the placement agent wants to get paid, community wants to get paid, the daughter, the family, the kids, they want mom to get in a place where she's safe and he has the care. But there's a problem. There's this house that needs to be sold, and you could list it with the realtor, but the realtor is going to say, well, I'm going to need 3 to 6 months to sell it. And oh, by the way, could you fix it up first? Could you clean it out? All that kind of stuff. So we literally are building a team of people, including elder care attorney and people who specialize in estate sales and helping to manage the disposition of different things. But the biggest issue is the emotional factor that mom has to now go from a 2,000 square foot house to maybe 200, 400 square feet. And she's got all this stuff she's attached to. So there's real opportunities in helping people in these transitions in life. And so I know some people doing very well that are buying these houses because they can pay cash and buy them immediately, pay a fair price, and then they can go and be the ones to help with the facilitating, the clearing out, the cleaning up, and the repair and resale. So that's another way, because the big problem, whether it's apartments or any kind of commercial or any kind of real estate, is where do you get these good deals? Where do you get these leads? Because there's been a lot of competition. If anything else, there's been more buyers than deals. And then on top of that, the properties have gone up. And recently, a lot of people are like, I got gold plated, whatever. It doesn't matter. I've talked to brokers, and the broker, I say, well, how much is the seller asking? 10 million. I go, but it's not worth 10 million. Well, that's what they want. And I say, well, I agree. If I was to put, 500 to $1 million renovations in this property, along with raising the rents, in about 2 to 3 years, it could be worth 10 million. Of course, the seller wants the future value that I'm going to put all the work in. And I see this all the time. I'm sure many of you have seen this as well, where you're calling, sellers are calling, and they want the future value of the property versus the right now property value. But this is why I brought up early on about these loans coming due, because there's 58,000 commercial properties that have loans that are going to be coming due in the next 5 years. And so if you begin to build these relationships with these brokers, build these relationships with these owners, build relationships with property managers, there's the most important thing is build, it has been said, dig the well before you're thirsty. So the whole point of digging the well before you're thirsty is the opportunity you're going to take advantage of in 2 to 5 years from now is based upon the decisions you make now in the first quarter of 2025, because there's going to be more foreclosures. There was a big foreclosure most of us have heard about. That was the one that some new operator had like 1,100 doors in Texas and specifically Houston, and there's Arbor, and took it done. And I actually had somebody approach me about that before they closed on it. Somebody from California was all excited. He was going to put $100,000 in it. And I said, well, this is what you need to do. You need to be thinking, who do I have on my team or have a relationship with that they can give me a second set of eyes? That's why I think Peggy's good at that. That's one of the things that Peggy offers with her group and everything. But you need to have multiple people on your team that can take a look at that prospectus, that you all need to be better at your due diligence, your underwriting, looking for, and sometimes you don't see it. Sometimes you get emotionally involved, get excited. It's so important to get the people on your team. And this includes legal. This includes every aspect, the due diligence of what am I missing? What did I not see? So when I looked at that particular offering, I said to him, I think this operator is inexperienced. He doesn't have a long-term. I prefer 20 years of people who are operating as general partners. And so basically he had a short term and he'd been sort of a rocket ship, but I could see that with interest rates those of us with experience, we knew interest rates were going to go up. So my understanding was he got caught in getting a bridge loan that he then couldn't fulfill. And there was a capital call I heard of about 40 million on that whole deal. And the investors said no. So they lost all their investment. So we're going to see more of this, because lately in fashion has been, get rich quick in apartments. And there's every guru coming out of the woodworks these days. They're saying, it's easier to buy an apartment complex than a house. I go, really? They go, yeah, the apartment will pay for the loan, so I don't have to qualify. Really? Who told you that? Some guru? So I go, well, let me explain the real world. Depending what's going on here, the lender is not going to make a multi-million-dollar loan to somebody who doesn't have experience, somebody who doesn't have net worth, somebody who doesn't have a track record. So they're going to look at what's the management. Because that's the make or break quite often. But also, when things go bad, are you just going to bail, or are you going to step up and do whatever it takes to solve the problem? And so there are situations out there with newer, less experienced people, and these problems are going to create opportunities, whether it's property mismanaged, they didn't understand the importance of hiring the right property management company and managing that property manager on a weekly basis. So let's see, how am I doing time-wise? I couldn't hear you, Peggy. 7 more minutes, something like that?
About 2 or 3 more minutes.
Oh, only 2 or 3. Okay, well, let me just show a screen real quick if I can. And hold on, I'm going to click on that. If I can get there, just a second.
You're muted.
Yeah, unfortunately, it mutes me when I press the share screen, but I'm going to just touch on this real quickly here. I got this right here. And there's, for example, 45,217 fewer nursing home beds available today compared to the pandemic. And another one I had, come on, right here, Yardi matrix here. Okay, so Yardi is something to become familiar with. And there's this article right here. And this is multifamily from Yardi. Here we go, good. Need faster Wi-Fi. Well, anyways, this was the article that was talking about how there is 58,000. It's coming, it's just going slow. There it is finally. So right here, loans on more than 58,000 multifamily properties are set to mature in the next 5 years, and they're gearing up for waiver refinances. And in addition to that, so you can look at Yardi Matrix, there's a research firm, but basically how big of financial impact? These loans represent 525 billion of the total 1.1 trillion of loans currently backed by apartments. And for example, Atlanta has 34.9 billion and set to mature by the end of 2028, the largest volume. Next from Dallas with 26 billion, and there's Denver with 22 billion, Houston with 20 billion, New York with 19.9 billion, Chicago with 18.8 billion. And but I'm just saying it's good to start doing research about this and these problems or opportunities. So with that, I think we're at about my time. I'm going to stop there.
Yes, I have a plethora of questions. I'll start
Right.
at the end. So you're talking about all these loans that are coming due. They're not due. They were 5-year interest only. Then they go to PITI, principal, interest, taxes, insurance, right? They're not due to be paid off. They're due to be paid fully. Do you understand?
Well, basically, there's maturities. So there's a cycle, and compared to a house, which has a traditional 30-year fixed loan, commercial loans, as we know, I've seen people get 2 or 3-year loans, and I said I thought they're crazy. We normally stick with a minimum of 5 to 7 years.
So you're saying these loans are only 5 years. They're not the 25-year loan that most commercials get, and that they have 5-year interest only, and then on the 6th year they owe the principal. They have to start paying principal also.
I've seen properties, quite a few, that in commercial loans, they have a 25-year amortization. So the amortization is over a period of time, but being a commercial loan, the majority of commercial loans that I see are due in full, payable within 5 to 10 years.
Okay. So when you're using your database, which usually would be maybe your title company.
Yes.
Are they going to show you whether it's a 25-year loan or a 5-year loan?
It depends on the source of data, because basically, we know loans are a public record. And so that's part of data. Titles are in the data mining. So depending on the title company, there's other sources too that specialize in this harvesting and selling this data. So basically you can know matter of fact, I talked to some brokers who were pretty sharp that were in North or South Carolina working those markets. And they said they were specifically targeting the list of owners that they could see the loan was going to come due in 2 to 3 years.
In South Carolina.
Yeah, in North and South Carolina, these brokers I was talking to, because those are 2 of the markets I'm working.
So they're working with their title companies on that.
In some cases, title company. In other cases, there's other data sources as well that compile this for you, and there's a fee as a service.
Oh,
to get these lists. Yes. Mm-hmm.
I'm sure about that.
Oh, yeah.
So you're talking about, well, you talked about a lot of different things. Thank you very much for that. Eugene was asking, what markets are you building your teams in for the resident assisted living?
Okay.
So you talked about that, and you talked about you're building a team. You kept saying
yes,
team. So
yes. Well, it's an ongoing, evolving thing, because what happens is relationships evolve over time. Sometimes we've had people that were on our team that they were okay with between 40 to 100 units, and now they've gone on and they say, well, I only want to deal with properties that are 100 to 200 units.
But where?
Aware. This has been mostly Texas. One of the people I've been involved with, the general partner, he had one in Greenville, South Carolina. So I like North Carolina, South Carolina, and Texas are three of my top favorite markets. And part of the reason why is because of growth. Now there's pluses and minuses. Some people really like Florida, but Florida's been really having a problem with the insurance with these hurricanes.
Okay, but you said we're talking about assisted living
Well,
or,
it's this.
or
Oh, yeah. With the
senior living.
okay. Well, I missed that part. I apologize.
Yeah,
So
because
I
you
didn't
keep
hear.
doing all these different teams. So you've got a team to buy multifamily, then you've got teams to buy foreclosures, you've got teams to buy assisted living, right?
Yeah, because basically what I do is that's why I'm speaking, because I network and I find people, and then people bring me opportunities. So then sometimes I don't have the experience. So I was just at this convention that was in Phoenix, that's the national convention for RAL, and I met probably 20 people there with very expertise in that space, some of whom don't have the real estate experience I have, and they're looking for a particular property. So then what I do is I don't want to be the operator for these properties, but now I've got a network of people that they're looking, and they may not know how to get the financing or know how to do a syndication, things like that. So I'm looking for circumstances where I'm going to find a distressed, and there's brokers that specialize in the space of assisted living. And then what happens is sometimes people don't operate them well. And what ends up happening is that lack of good management is an opportunity to turn them around. Sometimes it's a shortage of capital. There's a variety of common problems that happen, whether it's the assisted living or multifamily. It's pretty common either way.
So when you're putting a team together and they bring the deal to you,
Mm-hmm.
you work them through putting the whole deal together and making sure that it's going to be profitable. And then how do you oversee that maintains that? And that
That's good.
when
So,
they
so
5 years are up, they're not having to do a refinance and are stuck in whatever the interest rate is at the time, for instance.
Yeah, that's a great question. So basically, when I was at this event in Phoenix, there were several different companies there who are lenders who specialize in assisted living and those kind of operations, and that's the kind of loans they specialize in. So there's brokers who specialize in this, there's lenders who specialize in this. So most of the time, if I'm going to be working with an owner operator, they're not necessarily financially strong enough to qualify to buy the real estate and the business, because there's two that go together. So basically, I'm coming in offering help with being the real estate side, and they're the operator side, and preferably they're going to have some kind of track record, and or they're going to have people that they're working with on their team, they're helping guide them on making sure we got enough experience. But the key, like with anything else, is that right now there's a shortage. So the arrangements we're going to have is the goal, they're going to increase the value. One example that was given at this event I was just at, there was somebody that was doing a master lease option. So they would go out with their financial strength and they would buy the property. The property they bought for like 7 million. It then appraised for like 9 million, and the projections based upon maximizing the property it would appraise in the future after about 2 years for 14 million. So the owner operators were ecstatic about that because the value increased because of the cash flow, because of the demand for the beds. They would be able to come back and refinance at about, I think it was 11 million, something like that. And so they would be able to pay off the other party, buy them out, and there'd still be room that they'd have a nice equity. Did I go too fast on that?
You said it was a master lease, so they didn't own the property.
No, they didn't. But with the master lease, they had an option to buy it. So basically,
yeah, sure.
the
But they didn't
investors,
buy it, they refinanced out like it was a purchase and
yeah.
selling it at the same time.
So basically, that's what I'm saying is there's creative finance opportunities, and so these people who understand that there's people who can't afford to do a 10 million right off the bat, but once they've got 2 years or more, I think they had a 5-year lease option with the property. So their goal was within 2 years, and the projections 2 to 3 years, they would increase the numbers and the value. So it appraised for 14 million, and at the 14 million appraisal, it would now qualify for refinance and pay off the party who made the lease option to them.
Oh, and they would hold the property at that point?
Yes.
Oh,
Then they would be buying the property. Yes.
and they would be closing on the property, not reselling.
No. Yeah, they'd be buying and owning as the operator. Yes.
So do you have a due diligence list for each one of these areas?
Each area, and it evolves because as you go, you're constantly learning. So I've got my list, and then I compare notes with other general partners and people with experience, and they say, oh, have you considered adding this to your list? I go, oh, that's a good catch. That's why I'm so big about the second set of eyes. And I mean, I'm literally, one of my favorite things every day is I'm constantly learning, and especially the best way to learn is by doing deals.
Yes, it is. Agreed. So back up to seniors, you said people over 65. Well, I say people over 65 have money, but you're saying that they don't have money?
If you look at the nationwide of all Americans, 80%, I mean, a huge percentage of Americans are going to rely on their Social Security. They're not financially secure. If you just go survey, I talk to real estate agents all the time, brokers all the time, and I ask them, tell me about your real estate portfolio. Most real estate agents and brokers do not own any real estate. If they do, the only real estate they own is their home. A lot of times when I talk to them, they had a home that they maybe kept as an accidental landlord and rented out. But there's large numbers of seniors that they only have $50,000 total net worth to their name. And the biggest asset that most seniors have is their home.
So why would they give up their home? Because they could be there for the rest of their lives.
Well, that's what most, and especially it's typically going to be mom, and that's why there's this group that's called Mom's House. And so basically what we found, just as an investor that's out here buying, I would get a phone call one day and they'd say, hey, this is the daughter, we'll say daughter Judy, and daughter says, mom just fell and she was in the hospital and the doctors are saying there's a risk of her having a stroke or hitting her head, and she can't take care of herself. And mom's in Denver and I'm in Atlanta and all the kids are scattered all over the place. And we were having in-home health care, but that's not enough anymore. So we're going to need to take her to a residential 24-hour care place, but it's going to cost us $5,000 a month. We don't have that. So we're going to need to sell her home quickly to get the money to pay for this. And so that's the niche opportunity there, because what happens is a lot of times she's got accumulated stuff, more of a hoarder, there's deferred maintenance. And so if you go to a realtor, the realtor said, well, yeah, I'll list it for 3 to 6 months. And the daughter says, we don't have 3 to 6 months. Can you do it in 3 to 6 days or weeks? Because we need this money to get her the care she needs. So that's why there's a time-sensitive opportunity there.
Yeah, they're just talking to the wrong real estate agent. There's lots of real estate agents that work with investors like you.
Well, that's true, but I'm telling you right now, I call 100 real estate agents a month. Do you know the average real estate agent sells one house a year?
Yep, I do know that.
The majority, a large percentage, 80, 90%, they're like 50% of all agents have dropped out with the interest rate increase.
I know. It happens every time.
Exactly.
Every time. It's one way to clean out the industry.
Yes, exactly. Same with investors too.
Same with investors too, right?
Mm-hmm. Yep, absolutely. And lenders.
Fear, there's that fear factor. Fear drives.
Yep. So everybody's getting out at the perfect time to get in.
So people only have their home and they don't have any money. So they don't have an IRA. They don't have any retirement. So people are not being educated still about how to take care of themselves?
Correct. Out of 70 million baby boomers, there's like 50 million or more that are financial difficulty to the point of living literally on a very small pension, if there's any, and Social Security, being dependent on Social Security.
That's very, very sad.
Mm-hmm.
So now I'm going to shift to a couple more questions.
Right.
Oh, does anybody else have any questions? You know me, I'll bogart the whole half hour. So
yeah, I don't have a question, but Peggy, you already know that residential assisted living is a space that we're interested in. I will say, make a comment. The business model that you just defined, I have no interest in. The business model. So I'm assuming you were in Phoenix at one of the Guardinos.
Yes.
Yeah. Yeah. So my wife and I invest in this space. The only part of the space we're interested in, because the space, what you just defined, is a space where when the people run out of money, they're going to be dependent on government subsidy to pay for the residential assisted living. The space that really works, where people actually make the money that you're talking about, is where it's private pay not dependent on government subsidies.
Correct.
Otherwise, if you're dependent on government subsidies, because we do know people who have used that model, people run out of money, and then they're dependent on government subsidies, and the facility fails.
Correct. And that problem is an opportunity because that happens far too often. So then there's facilities and they're defaulting. And so if you can come in and purchase them and turn them around, it has to be the right location. It has to check all the boxes.
So the location's got to be a location where the average household income is $200,000 or more. Otherwise, so that's what we've decided if we invest in that space, the location, it's got to be that.
What state or city are you looking at?
Well, we look I live in Chicago, so
okay.
we look for like in Illinois, we won't invest in Cook County.
Right.
Because it's not high enough. We will invest in Lake County.
Right.
There's cities around there. So that's why I was asking the question earlier about what locations
Lake County is very good
for residential assisted living.
Mm-hmm.
Because if it's locations where the household incomes are low.
Yeah. So I'm in San Diego in Southern California.
Yeah, we won't invest in California.
Mm-hmm.
I just never been able to make anything work there. Anyway, I don't want to bogart it, but anyway, go ahead,
Hi,
Peggy.
that's my name. Go right ahead.
Yeah.
Jonna has a question, a comment or question.
Yeah, Mark, when you talked about I want to like kind of back up to you were talking about jobs and how you look at jobs. Can you expand a little bit on that? And are you looking at jobs in relation to some housing metric, or I mean, every town has jobs, right? And you get in there. How do you really weed out where that need is, right? Jobs to housing.
That's a great question. Well, right now, one of the areas I'm focusing on is South Carolina. It's because South Carolina has got a unique combination where there's affordable housing there. And part of the reason why is they don't have the high-tech jobs. When you get the high-tech jobs, like Austin for a long time, back in the 80s when I started, you could buy a house in Austin for $50,000. They're now $500,000 plus, largely because people came in from California, Google came in, Apple came in. So when the tech companies come in, that's where the income skyrocket. But if you get an hour outside of Austin, far enough away, you don't have that. And then with COVID, with everything has changed, there's people that are able to operate remotely. So we're seeing in outer lying remote areas where people wouldn't have been before, and it's beautiful. You don't have the traffic and everything else, but you can live there and then commute into an Austin or these bigger markets. So I'm typically looking for places that are the fringe, and they're still in the path of growth, but before it would have been said you're too far away. But with the change in technology and the changes in being able to work remotely, things like that, there's some niche opportunities that I'm looking at. So I like Texas in general, but Austin I know is going to have it's already begun a downward cycle. Nashville got overpriced. There's going to be some opportunities, I believe, in Florida. Miami's got overpriced. So I'm watching markets where there's foreclosures, they're going up, prices are going down, and I'm watching for the right point in the market cycle. But I know long term, there are people going to be wanting to live in Austin, but maybe not downtown with the traffic, maybe in the outlying communities or a county adjoining. One of the fastest growing in between Austin and San Antonio, there's New Braunfels. There's a couple different communities that are secondary, tertiary markets. They're not Austin. They've not been heard of, but they're good, bedroom communities. Does that make sense?
Yeah, but it didn't answer my question.
Well, I'm tempted to answer the question from the standpoint of I'm looking at the stats of who lives there. Like the gentleman just was on the call, he's talking about the income. And so basically what happens is in New Braunfels, for example, houses used to be 100,000. Now they're 300,000 and 400,000. They're not as expensive as Austin, but people can live there and commute there. And so basically that's what I'm looking for. And there's data you can pull up on virtually any city about what the median income is. So I'll look at, okay, it's 85,000. The state might be 57,000. So it's a higher than average income. So I'm watching for those places. And then also I'm looking at the unemployment rate, and I'm looking at what kind of industries are there. So like just north of Austin, there's a multi-billion-dollar plant going in, and it was in a rural area. So I'm paying attention to these trends. Does that make sense? Does that help any better at all or not? sort of.
That's
I
okay.
apologize. Maybe I didn't understand your question clearly enough.
Yeah, I mean it's all relative, right?
Yeah, it's all relative.
And so I was wondering if you had a ratio you were looking at, or
There's not a specific ratio. It depends, because what I'll do then is I'll start making calls. So, because again, the internet is not always, I know it's shocking, the internet's not always accurate too. So I do my own, pick up the phone calling and go visit areas, and I got boots in the ground, but I also become the boots in the ground in different markets. And I start making offers and I see. So I test markets pretty quickly, just with calling and making offers.
all right. Thank you.
Thank you.
Okay, good. Any other questions? I think Wesley. Okay, so you also talked about foreclosures are up.
Yes.
Is there a particular area where foreclosures are up?
Well, what I've been watching, I've got actually a client associate that I started training in 2019. He was making $4,000 a month on his job. He's now making $40,000 a month doing foreclosures. He's actually in Tehachapi, which is a smaller market, too small for him, but Bakersfield's about an hour away. So most people go, ooh, Bakersfield. Well, but it's about making the money. And so he's door knocking 10 pre-foreclosures a day. And in September, he said he had in the pipeline 6 properties. So, I mean, it has taken some time to build this momentum, but just focusing, and again, that's part of what I helped him with, is just getting very focused on the one thing he was good at. And he built a team. So he's got people who do dispositions because he wasn't as good at that. So he just does the one thing of going out door knocking and getting these leads in the pipeline. But there's other markets.
And that's one, Bakersfield.
Bakersfield's one. Chicago and Illinois, the foreclosures are up. New Jersey, the foreclosures are up. The other area is South Carolina, Columbia. So specifically what I'm focusing on and in California, there's going to be more coming, because with the high interest rates and with the economy, we're seeing layoffs. Part of the things I watch for, like in the tech industry, they've started having some layoffs. So I'm watching the data on a weekly, monthly basis and seeing where there's trends and changes in trends. And then there's also a thing called Atom data, and I'm looking at that and I'm comparing the unemployment, the layoffs in relationship, because people get laid off, especially if they got a high-tech job. They're used to having this high income. Property values went up a lot in Seattle. And so Seattle's been an area because there's been a lot of appreciation. So there's houses there that you could buy that have equity, but if I can get one that's locked in at a 3% loan and take over subject to that loan, there's a real opportunity there. So I've got niche opportunities, but I'm flexible enough that I've got like 5 different markets I can work, and I can be anywhere. I've got a unique opportunity there, is I've got the flexibility that any market I like, I can adjust and I can go there and focus on there and then build up a stronger team there. Typically on my team,
How do you find the markets?
Well, basically, the number one thing I'm doing is I'm networking constantly. And as I'm networking, I'm also a member of RIA groups. So like there's a RIA group in Seattle, there's a RIA group in Chicago that I belong to. At one point, I belonged to like 10 RIA groups in different markets I had interest in around the country. I was looking at Philadelphia. There's one called DIG there. I was a member and fly in quarterly, simply because I saw New York got very expensive. Boston got very expensive. Most of the Northeast was very expensive, but Philadelphia had pockets of affordable housing that you could buy that, I mean, I was in Brooklyn and it was $500,000 for a house that was a tear down, and I could get the equivalent in Philadelphia on the South Side for $100,000.
Right, exactly.
Yes. So niches, I'm watching for niches. And then I talk to a lot of people. I talk to 25, 50 people a day quite often.
Wow, that's keeps you quite busy.
Yep, I'm on that phone from the time I wake up to the time I go to sleep some days, but I'm having fun.
Oh, that's good. So these foreclosures, are you getting them from, so somebody comes to you and tells you that they're working on a foreclosure, but they don't really know how to do that? And so
that happens a lot. I was just in San Francisco at a meeting that was a networking meeting there. And so the gentleman who led the meeting, he's very big in notes. So he had a lead for a note that I might buy. Then there's another gentleman, he was a new wholesaler, and he's working, Marin and north of the San Francisco Bay Area. So he had some that were going to go to foreclosure that he was telling me about, and I know things that he doesn't know. And I've got a guy I'm training in North Carolina, and we've got about 3 leads right now that are pre-foreclosures that they're listed with the realtor, but they the one couple was from Florida. They bought in North Carolina, didn't know what they're doing, paid too much, got the wrong contractor, and now the house is sitting there unfinished, and it's got a hard money lender loan on it. So that's a kind of niche opportunity. I could come in, potentially solve that problem, make 25 to 50,000, and then
Right, but you do it for profit for you. What about educating these people as to how they can rectify the situation so that they don't lose anything?
well here's the reality. When somebody doesn't know what they're doing and they buy the wrong property or pay too much for the property or hire the wrong contractor and spend all their money, there's a certain point. It's like, well, how are you going to help somebody if the horse is out of the gate and gone? So I'm trying to help people to not make the mistakes I made, because when I started, I found the smooth talking salesman in Dallas, kind of puts his arm around you, buys you lunch, and next thing you know, you're being talked into paying retail for a fourplex at 60,000. It sounded great, and on paper, cash flow on paper, but there's so much I didn't know, and I see inexperienced people going in all the time and buying properties in the wrong areas, paying too much, getting the wrong contractor. There's a couple I've been working with that's in San Diego. They bought a property in Iowa, and they were told it was a turnkey, and it was a disaster, and it sat vacant for a year. So I'm constantly helping people cleaning up messes that, and I try to get to them before they have the mess. Yeah.
Yep. So they don't do their due diligence.
They don't even know what it is.
They don't even go look at the property, right?
No, half the people. And again, I said, how did the realtor was representing their commission, not them, because I said, didn't they, because the property manager was saying about the bedrooms being small and hard to rent. And I said to the guy, it's a couple, and I said to him, didn't the realtor mention about the bedrooms being small? And the guy's response was, well, yeah, he said something about that, but I didn't know what that meant.
Oh, and didn't ask?
Right. But this is common, especially people from California.
Right. They don't want to be embarrassed that they don't know.
Well, and I say that's why you got to get people on your team. I've thought about actually creating and offering a service for like some flat fee, like $500, that let me look at your deal before you lose 25, 50,000. I had a young lady in her 20s, and she was like daddy's princess, and she was coming to my class. I was on the board of directors in Houston, and I was teaching wholesaling and stuff like that, and saying you need to partner with someone with experience. So what does she do? Her very first deal, and this is back when 500,000 20 years ago was a lot of money in Houston. So that was her first deal. She decided to buy a $500,000 house with daddy's money. And the one, almost listening to my advice, she did partner up with another princess like herself. So instead of losing 50, she lost 25. Her friend lost 25. But actually the daddies lost 25 because they were just doing what their daughters wanted. And the fathers didn't know, the daughters didn't know. And it's like, I'm right there. They could have paid me a couple $100. And I would have looked and I said, but again, egos get involved too, right? And then people do things for the wrong things, not for making a profit, it's for ego. I just shake my head sometimes at the poor decisions I see out there.
Yeah, well, we must not be charging enough because we tell people we'll look at their deal, but we don't charge $500.
I know people that have paid more than that to gurus out there, and then they get in bad deals.
Well, they shouldn't be working with gurus because those who teach don't know.
Well, that's typically the case most of the time.
Those who know do, and those who teach don't.
And that's what I tell people all the time. You need to find people who are actually doing.
Right, out in the field. Well, I quit being out in the field. But then we aren't out there teaching people and making money at it. We're out there working with people to invest their money so their money works, because we have even better returns than I ever found when I was doing deals. So
oh yeah, well, there's some great opportunities. I spoke at the DME, which is Diversified Mortgage Expo, and I met a guy from California. He's got 100,000. He paid a note guru 40,000 4 years ago and has done 0 notes. Then at this event I was at, he just paid somebody else 8,000 more. And he said he's learned more from me without me charging him anything than he learned from those two that he paid almost 50,000.
yeah,
So,
right. And yeah, that's too bad. Yep. So we are at the top of the hour.
Okay.
Does we have a last minute question before we go? on any of this? It's been most interesting. And Mark, thank you so very much for being here and explaining all the different things that you do and how you work with people and support people in them getting out of trouble. So thank you very much for coming, and we hope you come back again sometime.
Thank you. Thank you, Peggy, and thank you, everyone.